Hey guys, my name is Kelvin and today I will be revealing my stock portfolio. But before I proceed, let me state out front, I'm not a financial advisor nor qualified in any way to give you financial advice. I am just a random dude on the internet, still learning how to invest, as you can see from my YouTube name. I've just started investing in 2018 where it was still a bull market. Anyone could have bought a good stock around that time and still able to make good money. So I'm in no way particularly talented, nor am I good at investing. With that being said, let's start. I actually have two stock portfolios, and both of them have entirely different philosophies, different rules of selecting its holdings, and entirely different goals. But today I'll be discussing about my first stock portfolio first, which is also my Singapore Dividend Stocks, and I will leave the second one for the next video. First, I will give you a brief history of how this portfolio started. Then I'll give you the guiding rules of this portfolio, then the goals, and how I choose the stocks, and finally the stock holdings. If you are only interested in my portfolio holdings and laugh at how lousy it is, I'll leave a timing down below so that you can jump straight to it. But if you watch the entire video, you might be able to learn a thing or two from someone who has over 1,000 days worth of experience in the stock market. How did this stock portfolio came to be? In 2016, I started out by trying trading in the stock market, and of course, I lost a few grand. I realized I shouldn't trade anymore. There's a quote out there saying that tough times don't last, but tough men do. So later on in 2018, I was browsing YouTube looking for funny cat videos when I came across Graham Stephan. I watched his videos and had an epiphany. I realized that by investing long term, you could actually avoid making losses. And above all, you could actually achieve financial freedom. What it means is that rather than focusing short term in the stock market, I could invest over a long periods of time and avoid all the mini market fluctuations. And by investing consistently long term, I will be able to build up my stock portfolio so that one day it will be able to provide me with dividends that is enough to cover all of my expenses, allowing me to quit my job one day and retire early. Next up, the guiding rule of this portfolio. The first two rules are by Warren Buffett himself. First rule, never lose money. Rule number 2, don't ever forget rule number 1. These two rules are extremely common sense, but most people are unable to follow this rule. Uncommon sense is what drives the market. That is why inefficiencies in the market exist. Prices are higher than it should be, while some prices are lower than it should be. Whatever stocks that I pick for this portfolio, I must be confident that they are profitable and will not lose me any money. That means never buying into IPO of new companies, never buying into penny stocks, and never buying into Bitcoin. That means buying stocks of companies which are actually profitable, have a competitive advantage, and management who are extremely capable in doing their jobs. Let me use an example between Snapchat and Google, which has a higher chance of being around after 50 years. The answer will be Google, right? Just think about it. What can replace Google as a search engine? What can replace their other products? Android, YouTube, Gmail, Google Maps. Their products are so pervasive in our lives that it's hard to imagine life without Google. And that is why, without even having to look at Google's financials, I'm able to safely say that Google will be able to outlast Snapchat. The third rule, stocks in this portfolio must be a dividend stock. This is because for me to become financially free, the dividends must be coming in year after year and be able to replace my income eventually. Rule number 4, I will never sell my dividend stocks as long as they are profitable. No matter how much they have gone up, 100%, 200%, I will still be keeping it in my portfolio. I will only sell the stock if the original reason of buying these stocks have changed. For example, if the management has become incompetent or the stock has lost its competitive advantage, then I will be selling the stock. Rule number 5, I should never have to spend too much time managing the stocks, and that is why the management of the company that I buy must be extremely capable. Then after that, the management should be able to handle all the work, handle the company operations, make sure the company runs well, and increase the company's profitability year after year. Well, for me, I should be able to turn off the computer, go to the beach, go traveling for 1 year, go become a monk for 10 years, and after I come back, the company should still be around, and not only that, it should have grown by a lot, and the company is still paying dividends year after year. Speaking of expectations, this brings me to the goal of this portfolio. This portfolio must be able to provide me with a steady passive income stream. First, I will be consistently putting in more and more money month after month, so that the dividend amount will increase gradually. On top of that, because the company's management are extremely capable, they will constantly seek to increase the profitability of the company, and in return, they will increase the dividend payout every year. And as an added bonus, whenever I receive dividends, I will just reinvest it back, so that I will be able to get an even higher amount of dividends. As you can see, when I add up all these three activities, I will be able to grow my portfolio at an exponential rate. It's kind of like this snowball, small and nice. And when you roll it down the hill, more and more snow will stick to this snowball, making it bigger and bigger and rolling down faster and faster. Until one day, it just takes off a life on its own, and you no longer even have to roll it, it just keeps growing by itself. That is the power of investing consistently long term. So, how do I choose my stocks? In one of my previous videos, I gave 5 rules on choosing dividend stocks. I'll put a link up here so that you can click to watch it. I'll quickly summarize the 5 rules here. The stocks must have a good amount of yield, good amount of profitability, good amount of debt, have a good price, and the company management must be capable. Let me show you what happens when I filter out stocks using all of these rules. First, I open up the SGX website. Initially, our total number of stocks is 723. So let's start by expanding the filters first. I want my dividend stock yield to be at least 4%. So I will set the yield to 4% here. Next, the company should be profitable. So I will prefer the net profit margin to be at least 11. The debt of the company shouldn't be too high either. So I will set the debt to equity to be below 95. The price of the stock shouldn't be too high. I will prefer the price to earnings to be below 20, and the price to book value to be below 1.4. So now, you'll notice that the total number of stocks have dropped to 33. And from there, I only need to study each of the company to know which are good and which to stay far away from. And with that, I will have my shopping list already. Every month when my salary comes in, it's shopping time. I will just choose which stock to buy based on its current yield and its current price. Or if the stock has dropped a lot, it's flash sale. So I will just put in more money also. If you are still here thinking when is this guy going to show his portfolio, you are breathtaking. And smash the like button. Without further ado, here is my stock portfolio. I'm currently using Investing Note to track my stock holdings, any stock news, and any stock discussion. I'm in no way affiliated with them, but if they want to collaborate, contact. Ascendas REIT is Singapore's largest list, with a portfolio diversified across 5 major segments of the business space and industrial property market. It has over 12 billion asset size and over 200 properties. I'm confident that this REIT will do well because the management is constantly looking out to acquire new properties to expand their portfolio. My holdings with them is about 15% or about $4,000. Next up, the CapitaLand Mall Trust. I can walk into any CapitaLand mall and feel like I own the place, or rather, a small part of it. Personally, I think that this REIT will do well because Singaporeans love shopping. E-commerce shouldn't affect this REIT too much because no matter what, people still need to go to mall to do grocery shopping, to dine out, or even just to buy clothes. However, the entire portfolio is in Singapore. I would like to see them expand to diversify away this risk. My holdings with them is currently about 3.14% or about $1,000. Next up, I have DBS and UOB in my portfolio. Both Singapore banks have a great track record of sustaining profitability over the long term. These banks have businesses all over the world, and if you believe in Singapore's future, you can bet on these 2 banks. But side note, Singapore will be issuing 5 digital bank licenses in the future. Traditional banks will be losing their market share, and it will affect their profitability. The banks have to continue innovating themselves if they want to remain as the top banks in Singapore and across the world. My holding with DBS is about 7.3% or about $2,500, and with UOB is about 3.68% or about $1,200. Next up, I have the first REIT in my portfolio. First REIT is a healthcare REIT, owning hospitals and healthcare facilities in Indonesia, Singapore and South Korea. However, recently, its sponsor, Lipo, was involved in a scandal, causing the stock to be downgraded and causing its stock price to fall. The other risk of this REIT is that most of its portfolio is in Indonesia. There is a huge currency risk because Indonesian rupiah to Singapore dollar is constantly dropping, which means that the dividend when converted back to Sing dollars will worth less and less over the years. And furthermore, this REIT has not been expanding over the years, causing its dividend to be stagnant. Currently, the yield of this REIT is about 8.5%. This REIT is the perfect example of a yield trap, where after you buy the REIT thinking that you will get a high amount of dividend, but actually the profitability of this stock keeps dropping. My holdings with them is about 5.9% or about $2,000. I'll be looking for a chance to divest away this REIT whenever possible. I have Fraser Logistics and Industrial Trust in my portfolio. This REIT has an asset total of $3.6 billion. Most of its properties are in Australia, some in Germany and Netherlands. The management of this REIT is quite capable. They are constantly looking out to expand their portfolio. However, there is a forex risk for this REIT because most of its properties are in Australia, and Australian dollar to Sing dollar has been constantly dropping. This causes the Singapore dividend to consistently drop even though the Australian dividend is constantly increasing. The management has been taking active steps to address this problem. Currently, my holding is around 14% or around $3,700. Next up, I have all the Mapletree stocks. I have Mapletree Commercial, Mapletree Industrial, Mapletree Logistics, and Mapletree North Asia Commercial Trust. You might notice that I like collecting Mapletrees, just like how Tonos like collecting gems. All of these REITs cover different sectors: commercial, industrial, logistics, and the retail sector. The four of them have a total asset of between $4.6 billion to $8.1 billion. I like these REITs because they are closely linked to Singapore's success: the industrial sector, logistics sector, the retail, and the commercial sector. All of its management are performing really well, and these REITs have properties all across the world. The only concern I have is Mapletree North Asia Commercial Trust, where most of its properties is in Hong Kong. Currently, Hong Kong's stability is problematic, with all kinds of riots going on, and with Hong Kong going into recession. However, the management has taken active steps to try to address this problem by buying more properties in other countries. My holdings for Mapletree Commercial Trust is about 7.23% or about $2,000. Mapletree Industrial Trust 19%, $4,300. Mapletree Logistics Trust 18%, $3,900. Mapletree North Asia Commercial Trust 6.5% or about $2,300. And that's all for my stock portfolio holdings. As you can see, I'm heavily invested into REITs and banks, and you may think that the risk is huge because all of them are in the same industry. However, here's why I'm not concerned. Banks has always played an important role in Singapore's development, and as for the REITs, they are in the property sector. Singapore depends very much on the properties for any kind of business. And besides, I see REITs as a mini index fund by itself because all of its tenants are from different sectors. The other reason I chose REITs and banks is that as long as Singapore is successful, these companies will still be around for a very long time. So that's all for this video. Thank you for being the only 2 or 3 person who stayed all the way until the end. Comment down below, let me know what you think about my stock portfolio or how can I improve it. Like, share and subscribe as I will be posting more videos every Monday. See ya!